I hope you have fun while you're learning. We've had a lot of fun making these videos, so hopefully it carries over to you. As you can see, we are Calibre Education, and there's little Caleb, after whom Calibre Education is named, and myself and my wife, we're a team. We make the videos, and hopefully you enjoy the videos and learn plenty about bookkeeping. So on this road, we're going to stumble across the advantages and disadvantages of being a sole trader. I will explain to you what a T account is. We will look at the yearly bookkeeping cycle. I will explain to you what cross-referencing means, what a transaction is. We'll look at some source documents. I'll look at journals, the general ledger, and I'll explain to you what a bank reconciliation is. This is an introductory lesson where I don't go into too much detail, but I'm just explaining to you some theory of accounting. I hope you enjoy it and you get a good foundation before we get on to the practical work. So let's roll the dice and get going. Oh, a 5. We're off to a flying start. When I started Calibre Education, I had to decide on what form of ownership I would like Calibre Education to be. So I needed to consider the advantages and disadvantages of the different forms of ownership. And this could be a question in a test, in your first test, but I decided on a sole trader or sole proprietorship for the following reasons after considering the advantages and disadvantages of a sole trader. So if we have a look at the advantages of becoming a sole trader, it is very easy to set up. It isn't costly. I get to make all the decisions as the owner with a sole trader. Legally, there isn't too much documentation to complete. It's very easy to set up. Not much capital is needed. A sole proprietor is normally a small startup business. Once again, if the business is struggling, there's less tax that needs to be paid. And if the business makes money, if Calibre Education makes money, the profits belong to me as the owner. Now, a disadvantage of a sole trader is there's unlimited liability. And what that means is my personal assets are more than likely attached to the business. So if I can't pay my debt, the money that I owe, then what they can do is possibly, depends how you set up, take your house or some of your assets. So that's a disadvantage of being a sole proprietor. There might be difficulty in raising capital. A big business, a company, can raise capital a lot more easily than a sole proprietor. A company would sell shares. If I, as a sole proprietor, needed money to fund my business, I would have to take a loan from the bank or use my own capital. Right, income tax, it's taxed at the owner's personal rate. So the amount of money that the sole trader makes gets added to my income. So it might put me into a higher tax bracket where I'd pay more tax, so that's a disadvantage. And also, in a sole trader or sole proprietor, normally the owner of the business is more hands-on, not necessarily, but I think it's quite important for the owner of a sole trader to be hands-on. I'm hands-on because, like I said, it's my wife and myself, and as you can hear, I'm making the video, so I actually quite enjoy it. So I wouldn't say it's a disadvantage. I am extremely involved in the business of helping you guys understand the basics of accounting better. So before I started up my sole trader, I just had a look, my sole proprietorship. I looked at the advantages, and for me, this was the way to go. Now remember, you could get this as a question. What are the advantages and disadvantages of a sole trader, a sole proprietor? Easy one if you do get it. So, ladies and gentlemen, what is a T account? In front of you, you have the general ledger of Calibu Education, and I've taken the capital account, one account out the general ledger, just to demonstrate to you where the term T account comes from. Now, this capital account is divided into two sides, the left hand side and the right hand side. The left hand side is known as the debit side, and the right hand side is known as the credit side. There are column headings on both sides for date, details, folio and amount. On the debit side and on the credit side, date, details, folio and amount. And guess what? You might have seen it already. If I just divide the two sides, we get a T. And that is where the term T account comes from. Now, the T account, it's not a formal way of doing things in the books, but the T account is used for lecturers to explain work. You might use T accounts in your workings. You can actually get asked a question, do transactions in T accounts? Then you would use these T accounts to complete transactions. But this here is where the term T account comes from. So if your lecturer starts drawing T's on the board, you know it's a rough working of a general ledger account, because a general ledger account is divided into two sides, the left hand side and the right hand side. And the left hand side is the debit side and the right hand side is the credit side. And just by the way, DR is an abbreviation from the Latin word debitera, and CR comes from a Latin word creditera. One would think it would be DT and CT, but now that you understand, these DR, the DR and the CR, come from Latin words. You can see why it's DR and CR. This, by the way, is a folio reference for capital, B1, and it comes from balance sheet account number 1, the owner's account. Remember, it's now called a statement of financial position, but more about that later. The point of this slide here is to explain to you where the term T account comes from. You're going to see it plenty over your accounting career. Cross-referencing. What is cross-referencing? Also known, possibly to you, as the contra account. Now the best way to describe this is to make use of a transaction, and we will use T accounts to do this transaction, and then you will see what is meant by cross-referencing, or in other words, the contra account. So if we have a look at this transaction, it says on the 1st of January 2024, the owner made a capital contribution of 600,000. Now what you need to do is you need to have steps to deal with any given transaction. Read the transaction, which I just did. Identify the accounts involved. Now I do a whole video on this, but remember, I'm trying to explain to you what cross-referencing and contra accounts are. So with practice, you'll be able to do things like identify the accounts. Now, I know if the owner makes a capital contribution of 600,000, firstly, the person that handles the finances in the business will take that money and open up a bank account. So the one account will be bank. Identify the two accounts involved. So the one account will be the bank account of the business. And look, I'm using T accounts to explain this. The second account is the owner's account, which keeps a record of what the owner puts into the business. And that account is called the capital account. Now these are the two accounts which result from this transaction. Then step number 3 here, it says classify the accounts by definition. You will learn that as you watch more videos. I would say a very good video to watch is my video on the accounting rules. It is thorough. You will know your rules off by heart. You will know how to classify the accounts by definition. By definition, bank is an asset as it has a positive bank balance. The owner's just put 600,000 into this business. And capital is its own category. I'm just going to say C. Now what we need to do is, we've classified the accounts in step number 3. Number 4, we need to apply the accounting rules. And I have the accounting rules here. Let me just rub out quickly the bank account so you can see this rule. I'll move it. And I'll write there B, bank account, which is an asset. If the value of the bank balance increases, which it has, the account must get debited. All assets, when the value of the asset increases on our books, the account is debited. I'm just going to write here 600. Now, also what gets put in the details column is the name of the contra account, the other account affected by the transaction, which is capital. Now what happens with capital is, the rule says, and I'll have to rub that bank account out again, but the rule says if the value of the capital increases, the account must get credited. So on the credit side of capital, you will have bank 600,000. Remember from the previous slide, the left hand side is the debit side and the right hand side is the credit side. So now what has happened is, in the bank account was debited, capital was written in the bank account under the details column, and in the capital account under details we wrote bank. Now that gives us a cross-reference between the two accounts, because bank was debited and it tells us in details of bank which account was credited. So there's a cross-reference between bank and capital. In the next slide I will write this out neatly so you will see it quite clearly. Now these two accounts here are also known as contra accounts. So let's have a look on the next slide where it's neatly typed out. As you can see, I've typed out those two accounts from the previous slide. We've got the capital account and the business's bank account, which resulted from the owner putting in 600,000 into the business. The person in charge of the finances put the 600,000 into the business bank account, and the capital account, the owner's account for what the owner puts in, was credited, increasing capital, and bank was debited as the value of the asset, the bank balance, increased by 600,000. Now, under details, the details column of the capital account is the name of the contra account, the other account affected by the transaction. In this case, the contra account to capital is bank. It goes under details. And the contra account to bank is capital, which appears under details in the bank account. Now these two contra accounts underneath the details column, they link the two accounts. They are a cross-reference. So if capital was credited, which account got debited? Under details you will see the bank account. And if you were in the bank account and you wanted to know what was the other account that got credited as bank got debited, you look under details and you will see the name of the contra account. So by filling in the contra accounts under the details column, we cross-reference. And where was this information recorded? It was recorded that CBR stands for cash book receipts. I have also a whole video on the cash book receipts, but I hope you understand what is cross-referencing. Cross-referencing is by filling in the name of the contra accounts in their respective accounts. There's a cross-reference between the two accounts that were affected by the transaction. That was quite a mouthful, but I think with my illustration you will see, and you can put it into your own words, what I mean, but you understand what is cross-referencing. So these accounts have been cross-referenced by filling in the contra account under details. I love this slide that you're going to see. As you can see by the background, this was made on a rainy day. So I took a picture of the window and you can see the raindrops on the window and made it my background. But on the slide you'll see in a moment, we're going to look at the yearly accounting cycle of any business. But my first series is on a sole proprietor, and I'm looking at mock transactions of Calibu Education. And if you wonder where the Cosmos comes from, the Cosmos originated at the time of lockdown when COVID was in full swing. I planted some Cosmos and they thrived, and I used the Cosmos to try and just light up some of my students. We'd gone on online, and we were teaching through the computer in an online space, and the Cosmos just hopefully provided a little bit of light, and it is a very pretty flower. But that's where the Cosmos you see on most of my slides originated from lockdown. And this is it, ladies and gentlemen. If you become a bookkeeper, you will be involved in this bookkeeping cycle, the yearly accounting cycle. But what will happen, transactions will take place. All those transactions will get recorded on source documents. The source documents are then recorded in appropriate journals. From the journals, the information is taken to the different ledgers. Then at the end of the month, reconciliations are done, and then there's a pre-adjusted trial balance, a trial balance at the end of the month. Now, the ones that I've circled, the blocks, that happens either on a daily or a monthly basis up until trial balance. Then at year end, adjustments take place, and you get different types of trial balances. Post adjusted, that means after the adjustments, another trial balance is drawn up. We will discuss adjustments at a much later stage. Their final accounts that are drawn up, so trading profit and loss accounts. And I apologize, but a motorbike has just ridden past, but that's how it is. Then we have a post-closing trial balance after closing transfers are done. Then financial statements are drawn up. We're going to analyze those financial statements, and then the first day of the new financial year, reversals take place. But what you have in front of you is basically what happens in a financial year of any business. Transactions take place, those transactions are recorded, there's a paper trail. You're going to learn, if you're just starting out in bookkeeping or accounting, this cycle. And in my videos, by the end of this series, where I'm doing a series on the sole proprietor, all this information on the accounting cycle picture in front of you will appear on a video. The videos will be numbered 1 to 40. You can go and pick what you want a video on. Debtors journal, debtors allowance journal, the general ledger, a reconciliation. If you're struggling with any part of this accounting cycle, there's a lesson right there for you at calibueducation.com. So go and have a look. Right, this is the yearly accounting cycle, the bookkeeping cycle. Quite often you will be involved on what happens on a monthly basis. Transactions, source documents, journals, and the ledgers, and a reconciliation. You get a bank reconciliation, a debtors reconciliation, a creditors reconciliation, and trial balance. That happens on a monthly cycle. The yearly cycle includes all this information in the dark green blocks. That's what happens at year end, and you calculate whether you've made a profit or a loss in accounts and financial statements. But this year is the yearly accounting cycle of a sole proprietor, but it's the same for a partnership or a closed corporation, private company. The basics are the same. I love this cycle so much that I've put it up again without any scribbling on it. You can have a look here. This is all quite exciting. You will learn all about this in your accounting journey. This year represents the practical side of things, but unfortunately, before we get to the practical side, there is a little bit of theory involved, as with anything. So quite a few of my videos, you can skip straight to anything on the accounting cycle, but it would be good to go through the theory of accounting, definitions, and some accounting principles, like I'm busy doing at the moment. I'm busy explaining to you terminology. I'll do a video on accounting principles, and I'm looking at theory at the moment. So enjoy the theory videos before you get on to the actual practical work. It's good first to know the theory. Don't take my money.
Don't take your money. Don't take my money.
Caleb seems a little bit confused there. Yeah, you can see he's got his money out and he doesn't want to part with it, but he has become a lot wiser with regard to money. He's not as confused as what he sounded just now or earlier. My first accounting teacher a long time ago, I remember when he first introduced accounting to me, he said, why do people go into business? You need to make a profit. And in order to make a profit, you need to transact wisely. So what is a transaction? A transaction occurs when there's an exchange of monetary value, or if an item that you have that the business owns changes in value. For example, if you have a delivery vehicle, it will depreciate over time, so there will be a change in value. But when there is an exchange of monetary value, that is the definition of a transaction. What might help you understand it better, what is a transaction, is if I give you some examples of transactions. And at a later stage, all the transactions of Calibu Education will be recorded in journals. But let's take a look at transactions, typical transactions of a business. Here we go. Here are some examples of transactions. On the first, Richard, the owner, made a capital contribution. The contribution was a vehicle. 100,000. Richard also made a cash contribution of 20,000. Returned stock, sold stock, paid telecom, cash sales. These are all examples, typical examples of a transaction. And remember, the transactions are recorded in journals: cash book receipts, cash book payments, debtors journal, creditors allowance journal. But all I'm doing here is I'm explaining what a transaction is, and these here are examples of transactions. The transactions need to be recorded, and that takes us to where are these transactions going to be recorded. You might have seen it on the accounting cycle on that slide. All these transactions will be recorded on source documents. As I mentioned, transactions are recorded on source documents, and so the paper trail starts, but every single transaction will get documented at source. So these transactions are recorded on source documents. There, a source document records a transaction when it takes place. And here I have an invoice, a credit invoice for either a purchase on credit or a sale on credit. There's a petty cash voucher for all these small little items that the business purchases. A record of it is recorded on a petty cash voucher. If you look at this credit invoice here, it is from a computer store to Calibu Education. On it is the date, the quantity, what was purchased, the terms and conditions, when will the laptop be paid for, as it was bought on account. But source documents record all transactions. I will show you a few source documents. I'm now going to look at the documents that are used to record cash receipts. This here is a cash tax invoice. The business that issued this cash tax invoice is Calibu Education. So there's Calibu Education, the address of Calibu Education. This sale was made to the school, and it was for 120 lessons on the accounting rules, and there's the price. But my point is, this document, a cash tax invoice, is used to record a transaction in the cash book receipts. Calibu Education will issue the original document and use the duplicate invoice, the duplicate cash tax invoice, to record this sale in the cash book receipts. So a cash tax invoice duplicate is the first document that I'm showing you, which is used to record a transaction in the cash book receipts. All these explanations here you can work through, but I have actually done a video on documents. You can go check it out. But for the purpose of this video, this is a cash tax invoice to record a cash sale to the school. And Calibu Education will be in possession of the duplicate in order to record this cash sale in the cash book receipts. This is the cash tax invoice from the previous page. I just thought I would show it to you without all those markings. Just something I want to point out here. The terms and conditions of a cash sale is cash on delivery, COD. The customer, the school, can't buy now and pay later. This is a cash transaction. So the terms of a cash transaction would be cash on delivery, pay straight away for the items. Sometimes it's difficult to see the whole picture. That's when we need to have a little bit of faith, and things become a lot clearer and you see the whole picture. What I've got here, or what you have in front of you, is a receipt. If someone pays us cash, another document to record that is a receipt. We at Calibre Education will write out a receipt. For example, here this one was a receipt for a capital contribution made by Richard. This receipt is signed, in this case here, by Mama, my wife. This is just made up, although I do have a wife, but the amount is made up. 250,000 was a capital contribution made by Richard to his business, Calibre Education. Then the cashier, Mama, received that money and documented this and issued a receipt. All money received, including that 250,000 received, is then banked. Now, in order to bank the money, we need to go to the bank and fill out a deposit slip. Now, a deposit slip is supporting documentation to record information in the cash book receipts. What happens is money comes onto the premises, either coins, cash, checks, and this money needs to be put in a safe place. So in this case here, Mama, Marushka Driscoll, will fill in this document, take the checks and the cash, and deposit the money into our bank account at the bank. But this document here needs to be filled in. And there you can see Shah Mama has just dropped off this money at the bank and filled in this deposit slip, and it was signed off. So a deposit slip is used to bank the money that has come onto our premises, because we're not going to sit with the money in our offices. That money needs to be deposited and earn interest, and there you can total up the amount that gets deposited. So this is another document that is used for supporting documentation for the transactions that have taken place during the month that go into the cash book receipts. You're going to see a really pretty credit note in a moment. There we go. So this is a credit note, an example of a credit note issued by the computer store to us, Calibre Education, as Calibre Education returned a laptop. The laptop was faulty, and the original sale, the credit purchase of Calibre Education. Remember, Calibre Education purchased a laptop from the computer store. That was the original transaction. But since then, this laptop has given hassles. It's been faulty. The laptop was returned to the computer shop. The computer shop agreed that the laptop was faulty and issued a credit note. So the credit note went from the computer shop to Calibre Education. The document that Calibre Education received was the O for original, the original document. Calibre Education uses that document to record the transaction in the creditor's allowance journal. All the information on this document is the same as what's on a tax invoice. And on the document, there needs to be the reason for the credit and the original sales details, which is there on the document. So this is an example of a credit note, which is used to record, in this case, we're in possession of the original credit note, and we're going to record the fact that remember we're doing the books for Calibre Education, returned a laptop to the computer shop and we received a credit, so we actually owe them less. I will show you how to record that transaction quite soon. This is the document without the pretty flowers. There we go. So that's the credit note. Might be a little bit clearer just without my scribblings and the flowers. Just a reminder, we're going to use the credit note from the computer shop to record the transactions in the creditor's allowance journal. And one more document for the purposes of this video. We have here a petty cash voucher, and a petty cash voucher is filled in when a purchase is made from the business's petty cash, money that's kept to make small payments. Here you can see I withdrew 500 Rand from the petty cash in order to pay for Caleb's computer lessons, and it was signed off by Marushka, who controls the petty cash. So in this video I've most probably gone into a lot more detail than what I intended to, but basically all transactions are recorded on source documents. When you watch the videos on the journals, cash book receipts, cash book payments, I go over the source documents again and in some detail. But in the theory of accounting, this video, all transactions are recorded on source documents, and you get quite a few different source documents. That's all you need to know for now. It's an introduction to source documents. From the source documents, journals are drawn up. There are at least 8 journals that we will cover: the cash book payments, the cash book receipts, the petty cash journal, the debtors journal. I will show you examples of them, but in the journals the transactions are recorded from the source documents that have been collected. Here, for example, is the layout of a cash book payments. You might know it as a cash payments journal, but anything that results in a decrease in our bank balance will get recorded in the cash book payments journal. But the purpose of this video is just to illustrate and show you what journals look like. Each journal will have a journal heading and a reference that stands for cash book payments number 1. Maybe you started off in January, and in the heading of a journal you will have the name of the business and what month the journal is being done. So in this case here, it's the cash book payments of Calibu Education for the month of January. And you will have column headings for document day, who's being paid, a folio for who's being paid. If it was a creditor, there would be a creditor's reference there. A column for bank, input VAT, trading inventory. You can have your own columns as the norm. A journal will have a column if, let's say for example, trading inventory is bought on a regular basis. So lots of transactions take place with regard to trading inventory. So it will warrant its own column. Some transactions that only take place maybe once a month will appear under sundry. So this is an example of a journal, the cash book payments. In the next few slides, I will point out and show you other completed journals. Remember, this is just an introduction, so now you are familiar with what a journal looks like, and I'm going to show you some of the other journals, and that's fine for now. But later on you are going to complete journals, all of these 8 journals I mentioned, and if you carry on, there are more journals. Salaries and wages journal is another example of a journal. But let's have a look at some completed journals for the moment. This is a completed cash book receipts journal for Calibu Education. This example, it was done for the month of February, and remember the journal got a reference, cash book receipts number 2, and all the transactions which resulted in an increase in our bank balance get recorded under the cash book receipts. At the end of the month, these totals are posted to the general ledger. So this information here, the cash book receipts, or the purpose of a journal, is to take the load off a ledger. But this is another example of a journal. So I've planted some seeds, and your brains are just sprouting, but it's going to grow and grow, your bookkeeping knowledge, and I look forward to working with you guys. Look at that, and soon you're going to blossom and flower. So keep up the good work, keep working at it. Let's move on. This is a completed cash book payments. There you can see the column headings. All the transactions are recorded in the cash book payments, or those transactions that have a negative effect on our bank balance. And yeah, you can see we've bought trading inventory, we've totaled up, we've paid for a whole lot of other expenses, but this is an example of a cash book payments. And at the end of the month, this information is taken to the general ledger, and these accounts are credited and debited. If you go and watch the video on the cash book payments journal, you will see this information is taken to the general ledger. So this is a cash book payments. I'm now going to show you a general journal. There we go. A general journal is a journal that records transactions that don't fit into any of the other journals. This journal sometimes causes a few problems, but this is what a general journal looks like. There we have the accounts that are debited and credited. There's a little story about the transaction. It's called a journal narration, but there's a video on the general journal. You can go and check it out, but now you at least know what a general journal is. And these green little pop-ups here are folio references. All these accounts will be either debited or credited according to the accounting rules in the general ledger. Because if you remember the accounting cycle, from the journals, the information is posted to the general ledger. And this here is a creditor's allowance journal. So if we return items to a supplier, it's recorded in the creditor's allowance journal, and you might have picked up a credit note is used to record this information. And just a little bit of history. That's where my logo came from. That's my office in the backyard where I'm sitting right now, recording this information in order to help you guys. And I'm going to take you to, if you stick with me, to another planet, the bookkeeper's planet. So keep up. Anything is about consistency. Keep working consistently and you will become good bookkeepers and good accountants. Don't work once a week. Work a few hours a day on your accounting, on your bookkeeping. Accounting in the clouds. Yeah, a couple more journals. There's a cash book payments once again for Calibre Education for February. I look forward to doing some journals with you. There's an example of a petty cash journal. So I think you've got the idea now. You know what the journals are and what they look like and where we're going. Journals record transactions from source documents, and the next step is to take the information from the journals, and we say in accounting, post that information to the general ledger where all the accounts are held. And this is an extract from a general ledger, and here I've got a capital account and a drawings account, the owner's two accounts, what the owner puts in and what the owner takes out. But this is what the general ledger looks like. Obviously I've only got two accounts here, but all the accounts of the business will be kept in the general ledger. There it says the general ledger is where all the accounts are kept. They're totaled and balanced at the end of each month. You will see we will put in entries here in the general ledger. The account will either be debited or credited according to accounting rules. I have a very good video on accounting rules. They are so important. Why is an account debited or why is an account credited? These general ledger accounts are balanced, and they will end up either with a debit balance or a credit balance. And at the end of the month, all the totaled and balanced general ledger accounts get summarized in a trial balance. This is an abbreviated trial balance, just to demonstrate to you what a trial balance looks like when it's done and what it consists of. But a trial balance is done at the end of each month, and the balances are taken from the general ledger of all these accounts. It's either a credit balance or a debit balance, and the debit column is totaled up and the credit column is totaled up, and you will see that the debits equal the credits because we're using the principle of double entry. For every debit there's a credit to the same value. So the trial balance is also a checking mechanism of whether our debits equal our credits, because if they didn't, we'd have to go back and see where we made the mistake. But quite a bit of information can be obtained from the trial balance. In the statement of financial position section, we've got the owner's accounts, owner's equity, we've got asset accounts and liability accounts. In the nominal accounts section, we have income and expense accounts. So if you wanted to calculate your profit, you could say income less expenses. You can calculate the owner's worth by using the accounting equation. The owner is equal to his assets minus his liabilities. But I'm just telling you what a trial balance is. As we progress with knowledge on accounting, you will be able to deal with all the things I have just mentioned. But for now, this is an example of a trial balance. In the trial balance, we have all the balances of the ledger accounts, and we can check if our debits equal our credits. So we're going along nicely. That's a trial balance. We've gone from transactions, source documents, journals, general ledger, and now trial balance. There we go. A trial balance is a summary of all the accounts of the business after they have been totaled and balanced in the general ledger. The trial balance checks if our debits equal our credits. By the way, if our debits equal our credits, that doesn't mean that everything is accurate, because we could have left out a transaction completely. We could have debited the wrong account and then we got an error. But a trial balance gives you a good idea of whether you've done your books accurately, whether your debits equal your credits, but it is not, if the debits equal the credits, that doesn't mean everything is correct. And like I mentioned earlier, on the trial balance, we can calculate quite a few interesting things from the numbers on the trial balance, but more about that later. And the last bit of information that I'm going to share with you on this video, this introductory video, is I'm going to explain to you what a bank reconciliation is. Now, at the end of the month, we receive a bank statement from the institution that we bank with. In this case, it's FNB, Caribou Education banks with FNB, And you will notice that according to the bank, FNB, we have 449,000 Rand in our bank account. But if we have a look at our bank account in our books, there's a balance of 450,000. Now what we need to do at the end of the month is we need to compare our books with the bank statement that we've received from the bank, and we need to find the differences, and we need to account for the differences. Every month there will more than likely be a different balance on the bank statement to what's in our bank account, and we do something called a bank reconciliation. We do the bank reconciliation in order to get the same amount in our books as what should be on the bank statement. We do something called a bank reconciliation statement, shall we say, on behalf of the bank, in order to correct possibly where the bank went wrong or what the bank wasn't aware of. But we will do a bank reconciliation. I will do one with you in one of my videos. I have wonderful steps to follow in order to complete a bank reconciliation. But for the purpose of this video, all we need to know is at the end of every month, a bank reconciliation must be done to find the differences between our books and that of the institution with whom we bank. The totals or balances need to be the same at the end of the bank reconciliation.
Bye, everyone.
Caleb says goodbye. Thank you for purchasing this video. I hope you learned quite a bit in this introduction to accounting, and I hope you purchased videos in the future. They will definitely help you with your studies wherever you're studying, especially if you're starting out in accounting and you're working through the bookkeeping of a sole proprietor or sole trader. But thanks again. That brings us to the end of this introductory video. I hope you enjoy the future videos with Calibou Education. Cheers.